All right. Good afternoon, everyone. Um, we are coordinated, David and myself. If we were in person, I think I would have liked to take a picture. Yes, our jackets are matching. We're talking about something a lot of people are facing. 2 years ago, when prices were really high, people did go in at closing time when things changed and the lenders weren't coming up with the differential of what was signed in their agreement of purchase and sale. A lot of people took the aid of private lending, sure that the market will jump up, and it hasn't. And there's issue in the system now, and as usual. David Corman has come to our rescue and prepared this amazing webinar, and I'm excited for everybody that's joined today. And we are recording this session as usual, and we will be sharing it on our YouTube channel. For anybody who can't seem to find the recordings, guys, everything that we record, we put it on our YouTube channel under Sutton Summit, so you can just go inside, sign in, and look at it there. But over to David, and thank you for joining.
Thanks, Sabiha, and thanks for that great introduction. I hope I can meet your expectations with this. You keep pushing the bar higher, but this is a topical topic, unfortunately, or fortunately, because what we're going to look at is lending and the rights of lenders, the rights of borrowers, options for borrowers, because some are going into two different markets. One is the institutional lending market, and the other is the private mortgage lending market, and there's differences. So I want to explain to everybody what the differences are, and then what the rights are from a lender, and then what the rights are of a borrower, so we can figure out how collectively, us as lawyers and you as realtors, how can we help our clients through the process and what their options are, and let them make the best and informed decisions in and if I don't mention this again, sometimes we're just helping them choose to pick their poison, which is their best option of sometimes options that aren't great either way, but it's good to know that there are options, and some are better than others. So we have to understand the process and everything. And like Sabiha mentioned, we're going to look at it from sort of two different points of view, from when we're dealing with private mortgages and things like that as an option. Some of it is just people that own their home and got a mortgage 3 years ago, 4 years ago, 5 years ago. Mortgage rates were historically low, and a lot of those mortgages have been coming up for renewal in the last little while. And the renewal rates are considerably higher than what they were paying. They were paying under 2%, and now they're renewing at 3 or 4 times that amount, just in terms of the interest rate. So that creates a hardship for some people. And then what are their options? Do they have better options? They have to refinance, their loans are coming due, or they've already come due, or maybe they got into default situation, they didn't do it. So some of it's for that market. The other is people that are coming, trying to close transactions. We see it a lot with pre-construction, again, because of the time difference. They bought 2, 3, 5 years ago on certain things, and now it's coming, and they may have had a mortgage approved, and now it's coming to closing, and their lender is saying, hey, we're not giving you as much money as we approved you for 3 years ago, because we just did an appraisal of this newly constructed property, and it's not worth the purchase price that you're paying for, so we're giving you less money. And now we got people scrambling to find money. Is there another lender they can go to? And sometimes they're short in time as well. So what are their options? Is there another lender? Sometimes they have to turn to the private mortgage market for that as well. So there's different circumstances that lead to this. So we're going to discuss all that. So just keep that all in mind. And obviously, you're going to want to try and figure out what you can do in the process to help this process along, beyond just understanding what your clients are going through. So let's jump into this. I'm going to just skip through our introductory slides here, and it is something that David and I have discussed on different podcasts, so you can always check it out on there as well. I think we've done 160 or so podcasts now, so please check that out. Please give us some feedback. We're always looking for new topics, new guests, and some feedback, so please help us out with that. So by way of introduction, we're going to just talk about the differences between a private mortgage and an institutional mortgage. So the easiest way to describe private mortgages is anything that's not an institutional mortgage. And institutional mortgages are from institutions that are generally governed by the Bank Act. So there's Schedule One lenders, which are the big lenders and banks that you're familiar with, like BMO and Bank of Nova Scotia, CIBC, RBC, TD. Those are the Schedule A banks, but there's also a bunch of Schedule Two lenders as well. There's trust companies, credit unions, a lot of insurance companies that do some lending as well. So, but if they're governed by the Bank Act, whether Schedule One, Schedule Two lenders, they're considered institutional lenders. That includes pension funds and things like that. So those are institutional lenders. If you're not an institutional lender, you're by definition a private mortgage lender. And we've seen private mortgage lenders could be some private individual. It could be Sabiha lending money to me. She's a private mortgage lender. Sometimes we see it people through their corporations, their holding corporations, or that they have that are lending money to other people. They're private mortgage lenders. Sometimes there are some companies out there that are really large companies that lend in a way that, from a big pool of fund, and they lend. So you think of them as institutional lenders, but they're not Schedule One or Schedule Two lenders under the Bank Act, even though they're big, large companies. Even those are considered private mortgage lenders, and there's different processes and different things they have to comply with. So there's a bit of a range in private mortgage lending. So that's the first part of our discussion: private mortgage lending versus institutional mortgage lending. And we prepared a little chart to assist us with just by way of comparison to understand the differences. So, in terms of type, I think I've covered that already. Institutional, it's the banks, the credit unions, the major financial institutions, and then everybody else is private, individuals, small lending firms, and it could be corporations that could be quite large, but they're not governed by the Bank Act or regulated by them. So they are private mortgage lenders. Now, one of the biggest differences, if you're an institutional mortgage lender, you have some very strict underwriting requirements and approval process. Income verification is a big part of their process. So getting mortgages approved from an institutional lender is much slower than it would be from a private mortgage lender who isn't as concerned with doing credit checks and income verification and things like that. They're generally more concerned with the value of the real estate when they're doing the valuation. So generally, they're set up to provide mortgage lending to people that can't get institutional mortgage lending. And oftentimes there's a rush and it has to be done on a short time frame. And just an easy example is that example I was just talking about, when like pre-construction people that, thought they've been pre-approved, they think they're getting the mortgage lending, and now we're, days or a week before their actual closing date, and their lender says, hey, we just did a new appraisal, the property's not worth as much as we thought 3 years ago. It's not even worth your purchase price, so we're going to give you less money. And there's only a few days till closing, so now they're scrambling. Now, some people have other resources to make up the difference, and they might go ahead with that institutional mortgage. Some don't have that as an option. They got to look to a private mortgage lender who's going to try and get this approved and processed and advanced in a very short time frame, and either advance the full amount and replace that institutional mortgage financing, or maybe they're providing a second mortgage to fill in the gap, because that's the only way that the borrower is going to be able to close the transaction. They're getting a certain amount from their first mortgage institutional lender, and they're getting a second mortgage to make up the difference. So the private mortgage lenders are geared up and have their processes in place to be able to respond quickly and approve things quickly. Now, because they're doing so, they're taking a much higher risk generally than institutional lenders are taking. So they're going to charge higher interest rates on private mortgage loans than you would be paying on institutional mortgage loans. They're generally going to be lending money for much shorter periods of time. You don't see too many private mortgage lenders that are going to give someone money for 3 years or 4 years or 5 years. It's usually more like 3 months or 6 months or 1 year. And it's done for a couple reasons. One is they're in the business of driving fees, and so they want higher interest rate, but they're also charging fees. lender fees, and they 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 put their fees in different ways. And if they do a loan for 3 months or 6 months, just to give someone as a bridge loan, to give the owner an opportunity to try and get institutional financing, usually they want their money at the end of that period, that short time period. And if they are going to agree to renew at that time, they're going to be charging a substantial renewal fee, and it's part of their business to earn a lot of money from their mortgage lending fees and renewal fees and things like that. So they generally want to put out their money for shorter periods of time than an institutional lender would be. In terms of down payments, private mortgage lenders can be flexible. They're usually looking for higher down payment. Institutional lenders are usually okay with lower down payments, but they're evaluating things based on the borrower's ability to have cash flow, what's their income, ability to pay the mortgage back, etc. So different criteria that they're using. In terms of credit requirements, private mortgage lenders are much more lenient, and they'll provide funding to people with very poor credit, because they're only providing in a short period, earning high fees and high interest for doing it, and they're prepared to exercise their remedies if there's a default. And they're very comfortable with exercising their remedies, and they go into some loans knowing they're likely to exercise the remedies because they expect that some of these borrowers are going to go into default, and part of their income is derived that way, and they'll choose their remedies. And I'm going to talk about the different remedies that are available in terms of power of sale and foreclosure and things like that, a little bit later in this webinar. From an institutional point of view, they're much stricter about credit requirements and need good credit history, or they're not going to want to approve the borrower. So, and the purpose of the loans are generally different. Private mortgage lenders are usually approached when it's a riskier opportunity, when the borrower's already exhausted their opportunities with institutional lenders and they're stuck, and they're looking for some short-term financing so they can get their transaction closed and protect their deposit, and then buy some time to try and find another way to refinance this or get better favorable terms and buy some time that way. And the banks and the institutions are looking for longer term financing. They want customers, and they want to be able to keep those customers for life and keep them away from their competitive institutional lenders and things like that. So on the private side, you've got high brokerage fees, high legal fees, high lender fees compared to institutional mortgages. In our firm too, when we're acting on private mortgages, we're charging higher legal fees to do those deals than we are in institutional mortgage lending. They're much more complicated. There's more things that have to be done. It's all done on a rush, and we have to spend the time and the resources to do it as well. So you're always on private mortgages going to find higher costs overall on all aspects of it. So I've already talked a little bit about some of this, but we just want to go through a slide here on why borrowers turn to private mortgages. And the first one is poor credit. Bankers are emphasizing credit score requirements. Private lenders are focusing more on the real estate. Okay, they're not looking to what the credit score is. They're not looking for the most part of what their what the income is of the borrowers and ability to pay it. They're more focusing on what's the property worth, and if they do default or they don't refinance and pay me out, and I've got to exercise my remedies, am I likely to get my money out? And am I going to get all my interest and penalties and discharge fees and things like that from it? So that's sort of where they're looking. So poor credit often leads people to look for private mortgage lending. Anybody that's self-employed or has irregular income, it often finds it difficult to get institutional financing because they can't just show that here's my income is all employment income. I've had this job. I've been at this job for a number of years. I get a raise periodically, and this is my income stream. It's easier for a lender to understand that as opposed to a self-employed person, small business owner who may be taking out some money in wages maybe taking some money out in dividends or bonuses or something like that, but they're not showing a regular personal income cash flow. Sometimes just leaving money in their business. Sometimes they use their business to pay for certain expenses that otherwise might be really personal expenses, but they run them through the business. It's harder to show what their real income is, and institutional lenders sometimes back away and don't want to provide financing. So they sort of force people with the regular incomes to look to private mortgage lenders to get financing. Sometimes just the urgency of the financing, there just isn't enough time available to go through an institutional bank approval process, and the private lenders can act way quicker. Oftentimes, we got a couple days from the time that a private mortgage lender is first approached about providing financing. We close them all the time, and they can get closed within 2 or 3 days of first looking or hearing of this property, and they can get funds advanced. So urgency often leads borrowers to private financing. And then mortgage arrears. Sometimes we've got borrowers facing default proceedings on their current financing, like I mentioned before. And whether it's a foreclosure or power of sale, they want to stop those processes against them. So they turn to private mortgage financing to get some money to put those mortgages in good standing or to pay them out and stop that foreclosure or power of sale from happening. So they don't want to lose their property that way. So they're looking to a private mortgage lender to help them out there. And then we've got other circumstances here as well. Sometimes it's non-residents, foreign investors, limited financial history in Canada. They can't get conventional institutional loans, so they're turned to the private mortgage market for that. So there's a bunch of reasons why they turn. So as promised, I want to talk about default. What happens and why? First of all, let's start with the common factors that lead to default, and then I'll talk a little bit about lenders' rights when there's a default, and then the borrower's rights when there's a default as well. So factors that lead to a default: high interest rates, especially when we come through a period that we have now when we had these historically low interest rates and people coming up for renewal. Now they're 3, 4, 5 times higher when they have to renew. And and then private mortgages have high rates themselves. So, that leads to default too, because people sometimes take on these private mortgages and just can't meet their payment obligations because the rates are so high. So that leads to default too. Depreciation of the property is something I've touched on a little bit already. The values are down right now. Property values go up, properties go down. We were very lucky in the GTA because we're more bulletproof than a lot of other markets, and our values generally hold. But even in our market, there's limits, and we see that in a lot of properties where the values have actually gone down, and that makes it difficult to refinance when mortgages mature. Another factor is a lack of an exit strategy when people get these private mortgages, and it might be for 3 months, 6 months, a year, but they need to be using that time actively to figure out how they're going to pay off that private mortgage when it matures, because otherwise those private mortgage lenders are going to get very aggressive with their remedies and default proceedings, and you don't want to be at the mercy of those private mortgage lenders and not have an exit strategy. And they should be on that with your assistance, my assistance, and making sure they have something like that. And then all the penalties and costs that accrue, it all eat away at a borrower's equity. And we see that time and time again, especially once a borrower is in a default position, it just starts compounding their default because they're getting notices of default issued, and they're getting charged for that. There's legal fees for the lenders that are getting charged for that. Lenders are going and spending money on appraisals and figuring out what to do with the property. They pass those costs on to borrowers. There's all kinds of costs that just start eating at their equity. And sometimes borrowers are just in a bad situation. The life circumstances change. Sometimes they're just poor financial managers. Sometimes they have high debt on other things, and they're moving money from one place to another to try and make up for it. Sometimes there are two-income families. One loses a job. Someone's got to move. There's a whole bunch of factors that lead into people getting into trouble. So our role is to try and help them through the process. Okay, that's what you're doing. That's what we're trying to do at Maya. We want to help people when they're struggling. So you have to understand what the rights of the lenders are and how the lenders are going to deal with default situations. So the first thing a lender has the right to do when there's a default under their loan is to demand full repayment. Sometimes a lender is sending out a very nice letter. Oh, you missed your March 1st payment. You never miss. We know you have a great history of paying, but sometimes people miss it by accident. They intended to move money from one bank account to another account. They didn't. All of a sudden they're NSF. So lenders aren't trying to be aggressive and throw them out generally when they do something like that. But you have to understand that lenders have rights. And one of the rights that they have, and it's usually right in their mortgage document, is that when there's a default, they don't have to just demand that there's you missed your payment or something, or there's an NSF, so we demand that you make it and put it back in good standing and pay us up. They can demand that the whole outstanding loan is due, even though there's 3 years left on the mortgage. But there's a default, they can demand that they be repaid immediately in full for the whole loan. And we refer to that as an acceleration clause. Most mortgages have an acceleration clause. So if a lender is saying that, I don't want you to just pay me the mortgage payment that was due on March 1st. I want you to pay off the whole mortgage right now, even though it wouldn't come due for 3 years. Because sometimes the lenders want that money back. They lent that money at 2%, and they'd rather get that loan paid out so they can relend that money out at 6%. So that's good business from a lender's point of view. So they would take advantage of that acceleration clause. So we don't want our mutual borrower clients to fall victim to that. So we never want them to be in a position of being in a default position that could trigger that. So you have to be aware of that. Another right of a lender is to charge late fees and penalties, and that can be considerable, whether it's an institutional lender or a private lender. Private lenders are usually way higher in terms of late fees and penalties, but the borrower is going to be responsible for those fees. Some mortgages provide that as long as the mortgage is in good standing, they're going to pay a certain rate, whether it's a fixed rate or it's a prime plus rate. But there may also be a provision in the mortgage that if they default, then a higher interest rate starts to apply. And that could be really onerous on a borrower. So they have to be aware of that possibility. Okay. So make sure you understand that as well, because sometimes they're in that default and all of a sudden a higher interest rate kicks in and now they're really in a worse position because of that. So the two main remedies that a lender is going to choose when there's a default is either power of sale or foreclosure. They can't do both. They got to pick their remedy and they're going to do one or the other. And I'm going to give you some more detail on both of them shortly, but just some basic information. So power of sale is the lender giving notice that there's a default, and if you don't pay by such and such a date, the lenders give notice that gives them a requirement, where they can pay by a certain date, failing which the lender has the right under their mortgage to sell the property so they can recover their mortgage debt, and they can use the proceeds of the sale to pay their principal, their interest, their penalties, their fees, their lawyers' fees, commissions, any other expenses they incurred in selling the property, whether it's an appraisal, if they paid for insurance, if they paid for property taxes. They can recover all that from the sale of the property. That's how they're going to get their money back. So they choose to issue a power of sale. The other major remedy they could exercise is foreclosure. And foreclosure is a lender saying, I don't want to sell the property, get my money back. I'm going to get a court order that's going to transfer the title and ownership of that property from the borrower to the lender. So the lender is going to say, I would rather own this property and then sell it to get my money back. So they go through a court supervised process. It starts with issuing a statement of claim, but the remedy they're asking the courts to approve is to foreclose the interests of the borrower and transfer the title by court order from the borrower to the lender. And I'll give you some more detail in a few minutes about the foreclosure process. Now, lenders also have the right to go after any guarantors, anybody that was a guarantor of a mortgage. They can go after it. And everybody that's a guarantor of a mortgage should know that. So a lot of times we've got parents helping out their adult children get their first mortgage and their first property, and they might sign on as a guarantor. And usually the lenders say, okay, we need you to be on title as well. So we might give that parent a 1% interest in the mortgage property. And they might be holding that 1% in trust. They're not the real owner of that. They're holding it in trust for their kids, but they're 1% on title. But as far as the lender's concerned and the law is concerned, they are 100% responsible for that mortgage loan. Even though they're 1% on title, they're 100% responsible for the mortgage loan. So a lender has the right to go after anybody that's a guarantor, and the lender can pick and choose. Lender doesn't have to exhaust their other remedies first before they go after a guarantor. Generally, they will. Generally, a lender would rather sell the property under power of sale and only go after a guarantor if there's still money outstanding or there's a deficiency or shortfall. But they don't have to. They can start their default process by issuing a statement of claim against the guarantors and suing them for the outstanding amount. It's just not the way they usually start the proceeding, but they have the right to. And lenders have the right to sue for a deficiency. If they sell the property under power of sale, they can go after the borrower, the defaulting borrower, for any deficiency, as well as going after any guarantors as well. And that certainly provides a negative effect on anybody's credit score if they're involved in a default process, either as an owner or as a guarantor. Now, lenders can also try and get possession of the property. If they're going through a foreclosure, that's part of what they're asked for. They're going to get possession of the property. They're going to get ownership, and part of that is anybody that's in the property is going to be kicked out. But even on a power of sale process, a lot of times a lender, in addition to issuing the notice of sale, will still be issuing a statement of claim and going through the courts to get possession of the property, because they might need possession of the property to do some staging, to do some showings. They might have an uncooperative borrower in there. They might have tenants in there. They might have to try and get possession of the property. So that's something that they might be looking at as well. And that's done pursuant to a court order. Now, when we're dealing with investment properties or properties that are tenanted, even if it's partially tenanted, maybe the homeowner is there on the main floor and they got a tenant in the basement. Usually lenders, when they're lending on those properties, whether they're private or institutional lenders, they're usually getting an assignment of rents and leases as security in addition to their mortgage security. So if there is a default, the lender can give notice to the tenants and saying, hey, the owner is in default, and we have an assignment of the rents and leases, so pay all future rental money to me, the lender, and don't give any money to the defaulting borrower, and they have the right to collect rents. So let's talk a little bit more about power of sale, and then we'll do a little more on foreclosure as well. So power of sale allows the lender to sell the property to recover their outstanding debt. Okay, and it's their full debt, whatever their legitimate debt is, principal, interest, penalties, etc. Any monies they've laid out in the course of selling the property under power of sale is recoverable as part of that lender's outstanding debt. Now, anybody that's buying the property from a lender selling under power of sale is going to obtain free and clear property. It could be a property that has a mortgage on it, a first mortgage. There might be a second mortgage. There might be a third mortgage. There might be a lien on the property. When the buyer buys that property and closes, all of those things will be wiped off title. They'll get the property free and clear of that. And the reason for that is when that first mortgage lender issues their notice of sale, they send notice to the owner, the registered owner of the property, spouses of the registered owner of the property, and everybody that has an interest in the property subsequent to that first mortgage. So the second mortgage lender, the third mortgage lender, a lien claimant would all get notice of that sale. And that gives them an opportunity, if they so choose, to try and redeem the property or put it back in good standing, pay it off, stop the process. And if they don't, or they can't, and we get to the closing date, their interest registered on title gets wiped out. They've got no more security registered on title because the buyer gets clean title to the property. Now, anybody that was subsequent in interest, if they lose their security, they lose their mortgage that's registered, but they still might be able to get some proceeds of the sale because the lender selling the property has to account to everybody that's subsequent in their interest to show them their accounting, how much they sold the property for, how much their outstanding debt was, how much they paid out, how much they paid out for your real estate commissions, how much they paid for lawyers, etc. Whatever their costs were, then this is what's left over. And then from what's left over, they got to pay everybody that's subsequent in their interest in the order of their priority. So if there's money for a second mortgage, maybe the second mortgage gets paid out in full if there's enough to pay them. If there's anything left over for the third mortgage, maybe they get some money. If everybody gets paid and there's still money left over, then the homeowner would get some money, uh, the original owner. Uh, but everybody is entitled to an accounting and to challenge whoever's selling the property under power of sale to show us what you sold it for, show us what all the debt was that was paid, and we need an accounting all the way down the line. So this is the most common remedy by most lenders. We don't see very many foreclosures. You hardly ever see a foreclosure from an institutional lender. It is a remedy that will be chosen sometimes by private mortgage lenders because they say, you know what, I see an opportunity here. I think I'd rather take ownership of the property. So even if the property is not worth what my mortgage is, I think if I take over the property, maybe put a little money into it, fix some things up, and improve the property, and then I can resell it if I want, and I might be adding value, and I get the equity in any increased value, or maybe I want to keep it, turn it into an investment property, do something else with it. They have that right to do it. So some private mortgage lenders are going to choose that if the dollars work out and they do the math and it makes sense for them to choose that and they take ownership. So key thing when on a power of sale, there's a process. Okay, there has to be a notice issued. The borrower has to get it. Everybody subsequent interest gets it, and then there's a process also for selling in terms of who gets paid what. It's got to go to people in order of their priorities registered on title, and anything that's left over after that goes back to the borrower. So a lender can't keep any excess selling under power of sale. Someone who closes on a foreclosure could, if they sell the property, if they foreclose on it and then sell it at a higher price, they keep whatever they sell it for. They don't have to account back to anybody. Okay, they've got court approval of the foreclosure. I'll talk about that. So there's a difference. Okay, now in power of sale, if the sale proceeds doesn't cover the full mortgage debt, the lender still has the right to sue the borrower and any guarantor for any shortfall. They're not giving up the right to sue by selling the property under power of sale. So they can still go after anybody that guaranteed it or the borrowers themselves for any shortfall. So foreclosure is the ownership. They get ownership. They start the process with the issuance of statement of claim, and the court's involved all the way along in the proceedings. The court's supervising the process, and the lender keeps all proceeds if they sell it. If they choose to sell it at some time, there's nothing that's going back to the borrower, no surplus. The borrower gets wiped out of any equity, if there is any equity or future equity. Now, because of that, and the lender's getting ownership, the lender is giving up their right to sue a borrower and a guarantor if it turns out that there is a shortfall. If they get the property and they sell it and it's less than what their original mortgage was, that's too bad for them. They chose this remedy of foreclosure. They can't go back after the borrower after the fact. So different remedy. Timing is completely different. It's a much lengthier process to go through the foreclosure process because everything is through the courts. Courts are slow. So it's not a remedy that's exercised very often, but it's certainly available. Now let's just look at this a little bit from a borrower's point of view, because borrowers have some rights as well. Even defaulting borrowers have some rights. And it's important that you're part of the process and make sure borrowers understand there's certain things that they can do. And the first thing that you should be telling any borrower, even before they're going to, if you know that they might be going to default, they have financial hardship. Okay, it's never a good idea to ignore a notice that's being issued by a lender or a letter, a demand, or anything like that. They should be anticipating their default if they can. Get in touch, open the lines of communication with the lender because there could be a bunch of different options available to them. And no lender likes a borrower that looks like they're trying to hide from their problems and to try and ignore it. So, oh, I never got that notice and everything. Well, the lenders got evidence that the notice was delivered properly. They got to satisfy the courts with all these things. So they know what they're doing. They're usually going to be delivering notices properly by registered mail, or a number of ways where they've got, or by process servers, and they've got evidence to satisfy court that these borrowers receive notice. So it's never a good thing to ignore it. Encourage them to open up the lines of communication. Make sure that your clients are getting the best professional advice available to them. Your advice as a realtor is crucial to them. They need a proper mortgage professional or mortgage broker helping them to sort through the various options that might be available to them, whether it's institutional lending or private lending. Um, and make sure that there's a lawyer involved in the process at the earliest possible stages to help explain these things and protect them. And notices should be given to the lawyer, and the lawyer can send a letter back to the lender's lawyer saying, hey, we've now been retained. We got this. We're dealing with it. We're not ignoring it. We're considering our options. Try and buy some time. Just open the lines of communication before that lender gets aggressive in exercising remedies. So we want to look at all options that might be available to help our mutual client get out of this. Is there an opportunity to refinance or do something with the current lender, or to buy some time, or to restructure the loan, or enter in a repayment plan? Or do we have to look elsewhere to refinance with another institutional lender if possible, or private mortgage lending? Do something, but make sure we're not ignoring it and we're dealing with this as fast as we can, and holding off the lender from proceeding with their remedies, if to the extent that we can. And sometimes we're just renegotiating back with the same lender if we can, when we've got these depreciated values and things like that. Because one option that we explore is sometimes a lender is prepared to take a haircut on their own loans. Sometimes the lenders that are, might be in second or third position, that know they're vulnerable, might say, okay, if you sell the property, the market's down, I know we're not going to get enough money to get us out, but I'll take 80 cents in the dollar, or I'll take 50 cents in the dollar, to get out, and cut my losses that way. You never know. So we have to open up those lines of communication with anybody, including CRA. Sometimes the CRA can be negotiated with to accept a certain amount as a settlement. So you never know who we might have an opportunity to deal with to accept this. We have to look at everything. Okay, and sometimes our mutual clients, like usually they want to keep their property and figure out a way to refinance and keep it. Sometimes it's just not feasible. And sometimes the best advice that we could give them is the last thing that they want to hear, and that they should sell the property before the lender sells the property. Because if the lender's selling their power of sale, they're going to be eating away at their equities so fast with the costs and everything that start building up in that process. So it's better usually for our mutual client to take steps to sell it. So they need your advice and your input, especially about market values and then other opportunities. Because if they're selling this, they got to live somewhere. So they're relying on you to give them options, whether it's rental options, short-term rental options, or to just downsize and figure out something else and buy another property. They have to know what's going on in the market of the property that they're living in, and they got to know what's going on elsewhere and what their options and alternatives could be as well. So here's a chart that summarizes some of the rights of a borrower when they're in default. So first thing is, they do have a right to receive notice. No one can sell their property or foreclose on their property without giving them notice and an opportunity to respond and defend themselves. So power of sale or foreclosure, they're still going to get notice. If it's power of sale, they're going to get a notice of sale. Usually a lender will make a demand just by way of a letter, even before they issue a notice of sale. but eventually they're going to get notice of sale. But either way, they're going to get notice of the process. If it's a foreclosure, the process starts with a statement of claim being issued. They'll receive that. It'll be served on them, and they have a 21-day, a period automatically to issue a statement of defense. But they'll get it to a litigation lawyer. Sometimes they can get more time than that if they're going to try and defend their position and hold off the foreclosure. But usually, a lender's going to issue notice, and then there's usually a 15-day period when nothing's going to happen before the notice of sale is going to be issued, even on a power of sale. And then the lender's going to issue, in a power of sale, they're going to issue notice of sale. And the notice of sale gives the borrower and anybody else subsequent in the lender's interest is also going to receive that notice of sale. And that gives everybody a 35-day period to pay the arrears and stop the power of sale process. So that's the redemption opportunity that people have. Okay, so and during that 35 days, the owner, borrower can put the mortgage back in good standing or sell the property, do what they want, because the lender can't take any further action during that 35-day period. So that gives them an opportunity. Once that 35 days has passed, the lender is totally within their rights to sell the property. They can then market the property, list the property, go ahead with their process, expose it, accept an offer, and proceed to closing with it. But during that 35-day period, they can't do anything. They issue the notice, and everybody that has an interest in the property has got 35 days to try and figure out what they want to do. So if you're a second mortgage lender, you get notice that the first mortgage is in default, you get notice of the sale. So sometimes a second mortgage lender might be in default too. They might start their own power of sale proceedings, but they have the right to, sometimes what they choose to do is pay the first mortgage lender and put the first mortgage in good standing. So they're stopping the sale under the first mortgage because that mortgage is now in good standing, and they might choose to sell the property under their second mortgage, and whatever's outstanding to them has just been increased by any amount that they paid to the first mortgage lender, and they can recover all that under their second mortgage, but they take over the process. So that right to redeem sometimes is used by parties that are subsequent in interest to stop the process of anybody ahead of them and take over the process because they get more control of it that way. Now, when you're exercising a notice of sale or power of sale, so you have these built-in notice periods that have to comply with, and then the property eventually is going to be sold. But there's a process to that too, and there's obligations on a lender when they're selling it, and this is protection for a borrower as well, because a lender just can't choose to sell the property and just accept the first offer. They're owed $800,000 on a property worth $1 million. So they put it on the market, someone offers them $800,000, and they say, okay, we'll take it because we'll get all our mortgage indebtedness paid. They can't do that and say, well, I don't care if, about that it's worth $1 million. I got my money out, that's it. They have to account to everybody behind them. So they have to try and get a fair market price, and they have to go through a process because they can be challenged as to their process and as to the price. And what did they do to expose it? So generally, anybody selling under power of sale wants to list it, multi-listing offer process, expose it, do showings, entertain as many offers as you can. Is selling in whatever market happens to exist at that time. Like they have no obligation to say, well, the market's not good in March, so there's no obligation to wait till June to sell it. If the default is now and they have the 35 days are up, they can sell it in March, but they still have to go through a process. We put it on MLS, we exposed it, we were accepting offers a week later, 2 weeks later, we got a few offers in, this is the best offer, and we accepted it because the borrower and everybody else can challenge them on that process. So the borrower has the right to expect that a fair market price was obtained even when a property is sold under power of sale. And a borrower has the right to get a surplus. So they want to see all the accounting from anybody selling under power of sale. So they want to see exactly what the lender is taking. What is the actual costs incurred that are reasonable and what was added to the mortgage debt. Because they have the right to that surplus. And they have the right to challenge the process in terms of whether notice was issued properly, whether there was excessive fees charged, whether there was unfair practices, what was whether the process wasn't complied with in terms of trying to get a fair market price for it. So they have the right to challenge that, and they have the right to get legal advice and get help and take advantage of any consumer protection laws that are out there. And there's various laws that there are available to them to make sure there aren't predatory lending practices by the lenders and unfair fees and abuse of process. So they have rights to be protected. So again, we want to make sure they have proper legal representation when they're going through a process like this. So all of that is going to lead me to the most important part that I want to talk to you is, and that's your role as realtors. So if I put you to sleep for the first 50 minutes of this, it's time to wake up. This part is so you understand how your role is and how you contribute to the process. And I can't emphasize enough how important the realtors are in all of this process, because none of us, on my position, when I'm acting as for a lender who wants to sell a property under a power of sale, or if I'm acting for the defaulting borrower, or I'm acting for a potential buyer, we all want information from the realtors because you guys understand the market and you can help do the math, because everybody is going to be doing the math from a different point of view, but they want to figure out which way to go and what their best choices are. Starting, obviously, the most important one is the borrower. Like, they really want to understand what their options are, and they have to have a good understanding of the market conditions and the property they're sold, the market conditions if they have to go back to the market to buy something else, what's available to them. They got to factor all that in, and you have to help them and hold their hand through that whole process and help give information to the lawyers that are helping to protect the borrower, lawyers helping to protect the lender, and lawyers helping to a potential buyer under power of sale. They all need proper advice from the realtor. And your other role is to make sure that they're getting the other team players that are needed in this process involved, the good mortgage professionals that understand the situations and the options here, the good lawyers that are familiar with these situations and can explain things to the clients in a reasonable way without scaring the crap out of them, which happens sometimes. So they have to be able to understand their rights and their options. And again, like I mentioned before, sometimes we're giving them options to pick their poison. So it's not always a comfortable situation, but we have to make it as comfortable as we can. You as a realtor, me as a lawyer, it's really important for us to do that. So we want to understand the risks, private mortgage versus institutional mortgage, the aggressiveness that private mortgage lenders could have. It might be their best option to take the private mortgage lending, but at the same time, let's figure out an exit strategy. How are you going to pay it out? Because if you don't, you have to be aware of the risks of the private mortgage lending and the practices of the private mortgage lenders, which are different than institutional lenders. So it's all part of the process. We have to help them understand the differences, and we need you as part of that process. It shouldn't be left just to the mortgage professional and just the lawyer. We need you and your input to explain and go through all this, and you should be part of the process. Here's some other information about how you as realtors can assist borrowers that are in default. And I just talked about one, you make sure that they get proper advice from lawyers and mortgage professionals in addition to your advice. But you play a critical role in doing assessments of market value for these properties. We have to figure out, you're approached by anybody that wants to sell their property. You should be helping them do the math to figure out, okay, what's you have a mortgage on the property, how much is outstanding, you have a line of credit on the property, that's secured on the mortgage, how much does that have to be paid off, is CRA putting owed money, are they going to potentially put something on, are there liens on the property? You have to help them do the math right up front to say, when we sell it for X dollars, which we think we can do, is there enough money to pay everything off? Because if not, we can't close the transaction, and there has to be additional monies put in order to make sure that the transaction can close, or we have to be able to go back to everybody that's supposed to be paid from the proceeds of the sale to negotiate with them to see if they'll accept something less than 100% or 100 cents on the dollar. So you have to be very involved right up front and help us with that and figure out what do the clients have ability to cover any shortfalls and things like that. And it's always a better process. For anybody that's in a defaulting type of position, it's always better for them if they can sell the property themselves instead of getting it sold out from under their feet, because it just starts eating, the costs just eat into any equity they might have had. And if the property is going to be sold, either because you're helping them sell their property or it's going to be sold by a lender under power of sale, they got to live somewhere. So they need a plan. They need to find a rental property, or maybe they got to find another property that's more affordable that they can buy. They need their options, and they got to figure it out and figure it out fast. So your involvement as a realtor, to sum it up, is really crucial in all aspects of this, in the explanation, in the valuation, in the hand holding. And it's really easy when we're living in a market where everything is good and the values are there and you got to sell it. Okay, I'll sell it. It's worth more than my mortgage because the market, because everything's appreciating in value and everything. Easy to be an agent and do those closings. It's much tougher to be an agent that's helping a client when times get tough and they're in their darkest time. And now you're in there saying, hey, I'm with you all the way. I'm going to make sure you got a good mortgage professional. I'm going to make sure you got good legal advice. I'm going to be with you all the way. We're going to get you this property, this process. We're going to figure out what your options are. We're going to pick the best option. We're going to do all the math. We're going to figure it out. And at the end of the day, we're going to get you through this. And if we can keep the property, that's great. If we have to sell it, we're going to sell it on the most favorable terms so you keep some equity. We're going to find, and if you're moving, we're going to find you the best downsizing options available or rental options. And we're going to be with you all the way. And you do that, you're earning a client for life. Okay. You're remembered and appreciated much more in the darkest times, in the most difficult times. And same thing on my end as a lawyer. We're appreciated more when we help our clients that are going through difficult times. And that's when you're going to get the referrals from those clients that love you so much. And they're going to tell all their friends and relatives how great you were as an agent and all the extra things you did to help them through the process. You got them the best mortgage broker. You got them a great lawyer to help you with the process. You helped them negotiate this. You helped them figure out that. They're going to be telling these stories. So hopefully you get them to the other side in a positive framework, and it's going to only add value to your relationship and add value to your business. So please appreciate that. And that should be your big take home from this. So with that, I'm going to throw it back to you, Sabiha. We might have some questions or something in the
Yep.
chat.
So I wanna bring forward a couple of things that we were faced with in the last few months. And as I mentioned, guys, and this is for David as well. So, there was a lot of people that did close, including realtors and clients of the brokerage that closed properties with the help of private lending, solely or partially. Okay. And this happened throughout last year and the half of the year before. There were times when at the end of the day, like it was a 6 months or a 1 year mortgage that were taken with by private lenders, and at the end of the day, it was a realization that maybe we can sell the property and we can pay off the lenders and the market will fix itself, and it did not. Okay, so I want to bring out two live examples that we were faced with, two completely opposing deals that we were faced with. One was our realtor was representing the buyer. The seller, that is had nothing to do with us, was represented with another brokerage, was the one that the lender came after. Right. So on the day off, or maybe 3 days before that, I got 3 or 4 or 5 packages from the law firm of the lender for the seller saying this deal is not going to go through, blah, 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 whatnot. You inform your clients, and this package is for the realtor, this package is for the lawyer, this package is for so now our client was in that place where they sold their home and they realized 3 days before that they have nowhere to move because it was same day closing. So just for you guys to know that this happens, and there will be circumstances like this that you come across. Um, and hand holding, yes, but there should also be very quickly pivoting as to what can you do for your clients and in that short period. You have to be hands-on and you have to realize that it can happen. Wrong advice was being given to a realtor by the lawyer that, oh, it's not going to affect your closing, and no, it will affect your closing. And so when our realtor came to my office, I told her off that this will affect your closing. And she was informed not to talk to her clients. Absolutely talk to your clients. Information and in putting information right there makes people aware. It's not to scare them off. It is just for them to know that this can happen. And that's exactly what happened. The property could not close. So that's one, and we'll expand on that a little bit. Another one, which I quickly want to put through, is the fact that David mentioned quite a few very important things. Is, for instance, they have to sell at the right price. The lender in foreclosure must sell at the right price. Okay,
Yeah.
so there was another deal of ours, which there was a private lender involved. Private lender wanted their money back. They were not extending the um, the loan. The 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 client could not sell the property after closing. That was the plan. Reconstruction purchase. They're going to close the property. They could not obviously sell the property. Market changed and shifted, and the lender said this was that time period. You had 1 year. We're pulling out our funds. Okay, so private lender came in and listed the property, sold the property while our client had it listed. Our client had the listing up and had also sold the property. Now, before the closing, David, right? So say, for instance, an example, 16th February was the closing date of the lender's deal. Our client had also listed the property, sold the property, um, you know, right, the closing was right before the lenders, right? Even though the date of selling was after the lenders. Right off the bat, from the beginning, we had a litigation lawyer help out our client. We got a litigation lawyer involved, and so our client was able to sell the property to their chosen buyer, not to the. So there are all of these nuances, and this is I know it's like what David said is that you might be napping for the first 50 minutes. It might seem like a really long shot that you will never be coming across this, but trust me, it happens all the time. I got a call from one of our realtors who sold their own home where the buyer is basically not showed up for the showings that they had, the inspection showings. The closing is in 2 weeks, and our realtor is very worried because this was their own home that they're selling. And guaranteed because they were selling their own property, the buyer was selling their own property, guaranteed there's some issue with that on this end. So this does come across, and this does become a very valid topic when you're in the middle of it, but it should not be something that you are scared of and you run in the other direction. You can be faced with it for your client, and you can be faced with it indirectly when your client is purchasing or selling a property to another party, which is faced with this. So it's a very, very active subject today, especially for people that have bought or sold houses in the last 2 years, right? Where the prices of the property were up there, and the mortgages kind of fell short a lot in the last couple of years. So, yeah, so I suggest that if anybody has any questions or whatever, but I just wanted to bring to your knowledge that this is a very active sort of a thing that we're faced with a lot in the last, say, a few months.
I wonder if I could just inquire. So, David, when we realtors go into a client's home, and often it's a client we don't know, they maybe it's a cold call, they don't generally share that they're under power of sale with us agents. You know, Uh, they don't see it as being a benefit to them, and they're probably right. So,
No, they're not right. Like when they're sort of, you're saying, Gail, they're going to retain you to sell the property and not tell you that they got a lender that's about to sell the property as well because they're in default.
Well, they might not be at the point where the lender is going to actively proceed to put the property on the market,
Yeah.
but they do understand that there's probably not going to be enough money for commission. So generally, I have an experience that they tell me, not at the first go round, and after 3 to 5 weeks or sitting down and negotiating, or you get more information from the seller starts to feel guilty. But I don't I
So
haven't run
Gail, we do have a form in
into
our package, which is the mortgage verification form.
yes.
Okay. And if done right, a listing, this is why it's so important to attend these webinars and all of that. That's a great question, Gail, because the fact that now you realize, and it'll be more so for somebody who has bought the property in the last 3 years, where the market had really gone berserker on us, and people have been faced with very high mortgages, right? Also, people whose mortgage is coming to term now, the 5 year period, right? Because a lot of people hit the trigger rate and may possibly have accumulated a 60, 70, $100,000 mortgage on top of their mortgage, right? So these are very valuable and viable conversations to have, and that is why we have that mortgage verification form signed by our clients. It still might still, I mean, and David, full floor to you, but I'm just saying from the brokerage end, we do have that form there, right?
Yeah, and these are questions that I think you've got to be asking potential seller clients, one way or the other. You want to know, like they're looking to you to tell, how much they're asking you basically how much think you can get for this house, do a valuation and everything. And and that's a legitimate question from them. That's what they want your knowledge for. But you also want to know what you're selling. You want to make sure the transaction is going to close. So I think it's an essential question to, how much you got a mortgage, how much is outstanding property? Is there a line of credit? Is it secured on this property? Is there anything else, on title that I should be aware of? We're gonna have to deal with because sometimes the math just doesn't work, to sell a property because there isn't going to be enough money to cover the encumbrances that are there and cover the commissions and the legal fees for closing. But that doesn't mean you can't still sell the property. There just has to be a strategy to make up the difference. And they've got to be upfront and honest with you, otherwise you can't do your job properly.
Yep. And I mean, those questions in the presentation is why are you selling the home right now? Then you have the mortgage verification form, all of those things. And you gotta, it's also the building of trust between you and your client. Like I told you, we were able to sell somebody's house where there was a foreclosure in place, where the um, lender ended up listing the property, putting a lock on the house, saying, we've taken over. And even in that, we were able to, sell that property for our client. So circumstances do happen. Clients need to know that they can trust you because you're well informed enough to have the answers. And you don't have to have them solely, guys, right? This is for everybody. You don't have to have the answers. This is why I'm there. David is there. All of us are there for you've got a great legal team. You've got us. You've got a mortgage broker on our side. You've got Gio to ask all these questions and say, okay, what can I give my client as options in this scenario?
And you
You
get a
know,
good coffee at the same time.
you get a
Good coffee for
great
you.
espresso.
Yes, very nice.
Just as a soft note, I was thinking about this the other day that you know, I was in the coffee business. You guys know that, right? I used to have Timothy's World Coffee in
Timothy.
downtown. I ended up with four at one point. And I was thinking that our terms and terminologies of meetups here are more and more trending towards that, with coffee with Sabiha on Monday, and then espresso with Gio, and so yeah, coffee is something that's not leaving me. So,
How about
anyways, thank you all for joining.
roll up
There
the
you go.
room with Gio? Roll up the room with Gio.
Okay, guys. Thank you, David, for an amazing session, and I hope
Okay.
you guys gathered some information at least to know that we can. Oh, and I want to give a shout out. Miss Jody Simpson is our brand new um, hire and recruit at the brokerage. Guys, please reach out to her if ever. Yes, Jody, welcome to a great team, and I'm so excited for you and. She's here with us. She's a brand new realtor, but an amazing personality, amazing person, and I'm sure she's going to go far. And please, if ever she reaches out, guys, please lend her a hand.
Thank you. Oh my gosh, that was so sweet. I would come off camera, but my background is like horrible right now. But thank you so much. I look forward to working with many of you.